The affordability challenges for homeownership continue, yet we are still seeing buyer demand hanging in there. In fact, we've seen purchase applications up 20% year over year. How is this still happening? Let's talk about what's going on. I also have some tips for any of you who are investors of some areas of the valley that have seen an increase in renters. So we will get there in a bit. Thank you for joining me this week. Let's start with this affordability. So from the Phoenix New Times, they wrote an article saying, how long do you need to save to buy a home in Arizona? Now, I will say some of the methodology that they used to get here, you could kind of give and take a little bit. So this is definitely not set in stone, but it does give you kind of an idea of, what you might need to do, how long you need to plan in order to buy a home in Arizona. In the last 5 years, the amount of money you need to buy a home has skyrocketed. But now that owning a home in Arizona is expensive, how does the quest to own a home here compare to other states across the country? So they used data from the Bureau of Economic Analysis and the 2023 American Community Survey. Long Island-based real estate company Leave the Key attempted to answer that question. They used the average monthly income for each state, subtracted monthly expenses like rent, food, utilities, and more, and then used what was left to calculate how long it would take to save enough for a 10% down payment on a median priced home. So when we look at where we're at with Arizona, they say the fourth longest time to save for a down payment to afford a deposit on a $411,000 home, residents making an average income must save up for 8 years and 4 months. So if you're looking to get into a house quickly, head to Wyoming, where the average income gets you a median priced home in just less than 2 years. So it's no surprise that affordability is not in our favor right now. And as we look at these numbers, like I said, I think you could kind of give and take a little bit on this methodology they used. If they're, using household income, if they're looking at the median home price and a number of different things. But long story short, it's not the affordability that we once saw throughout Arizona. And there are certainly other areas of the country that are much more accessible for homeownership. Now, this isn't the only challenge. I'm sure you guys have been hearing about insurance as well. So home insurance rates growing at nearly double the rate of homeowner income. Zillow just did this study and shared this information, saying that, in various areas of the country, as I'm sure you're aware, many of those areas are seeing an increase in homeowners insurance, particularly in those areas where there's a higher risk of natural disasters. So not too shocking, but Miami has experienced a 57% growth rate in insurance premiums. Across the Miami metro area, 1.4 trillion of residential real estate is at major risk of extreme wind. So getting into a home in Miami, you also have to think about what that insurance is going to cost you. And for many buyers, that is prohibitive. And so they may choose to live somewhere else. So obviously, overall, this affects sellers as well because it affects home values when people are considering some of these extremely high costs for insurance. Sacramento has seen a 54% growth rate in insurance premiums among major metro areas. Sacramento has the second highest share of homes at major risk of wildfire. For Florida, Jacksonville, 51%, Orlando, 49% growth. That's for extreme winds. Richmond has seen a 48% growth in premiums. 95% of homes in that area face major risk of extreme wind. Now, of course, I wanted to see if Arizona makes this list because we aren't known to have very many natural disasters here, but Phoenix is on the list, showing that homeowner income growth since 2019 is only 27% as compared to the insurance premium growth since 2019 at 40%. So we are feeling this here in the Phoenix area as well. Now, obviously, this affects buyers depending on their situation. So if they are a first-time home buyer, a retiree who's on a fixed fixed income, a landlord with multiple homes, in an area facing a high climate risk. All of those can be a little bit more prohibitive for those types of buyers versus someone who might have a little bit more budget and maybe discretionary income to be able to apply for these insurance costs. Now, they do say that currently about a third of for sale listings in the US are considered affordable for a household making the median income. And so the good news is, even if insurance premiums were to increase by 10%, 20%, or even 30%, they say the stock of affordable homes among these currently listed for sale would decline by only around 1%. So as we look at the country broadly, it isn't making a huge impact on everything, but there are some areas that are seeing this a little bit more than others. They say, for instance, if insurance were to rise by 30% in New Orleans, where 84% of homes may face a major flood risk and virtually all homes face major risk from extreme wind, the number of affordable listings would drop by more than 12%. Oklahoma City, they say that the number of affordable homes there would drop by almost 11%. So there are some areas that are more affected than others. Now, we know from these articles it could take up to 8 years to save to buy a home in Arizona. You might face insurance risks and an uphill battle there with increasing insurance costs. And if you were looking for a luxury home under $1 million, forget about it here in the Phoenix area. In fact, there are only 7 major metros where you can still buy a luxury home for less than $1 million. And there used to be 30 different metros as of 5 years ago where you could achieve this. This is a study that was done by Redfin. They were looking at their home sale price tier data with luxury homes defined as those estimated to be in the top 5% of their respective metro area based on prices of homes sold over a rolling 12-month period. So when they look back, they see that Detroit is the number one area where you can still get a luxury home for under $1 million. However, if we look back in time, like to 2015, it would only cost you $415,000 at that time. Median luxury home sale price in 2020 was $532,000, and now today $753,000. Still has increased, but it's still under $1 million. A number of other metros, Cleveland, Pittsburgh, Indianapolis, St. Louis, Cincinnati, and San Antonio, all areas where you can still find that. So if you are looking for a luxury home under $1 million, that's where you need to target, certainly not Phoenix, Arizona. Now, on the flip side, we have San Francisco, San Jose, Anaheim, Miami, and New York. All have a median luxury home sale price well over $1 million. In fact, $4 to $6 million. But where does Phoenix stand on this list? So as we go down here and we take a look at all of these different metros, we have Phoenix with the median of $2 million in order to get into a luxury home here. Now, I think they went back to, let's see, what was this, 2020 and then 2015. So in 2020, it was $970 was the median, and in 2015, $805. Really not a bunch of growth in that 5-year period, $805 to $970, but then a jump from $970 to $2 million in the course of 5 years. So that's what it takes to be in luxury here in Phoenix, at least on the median. So you can leave behind any thoughts of finding a luxury home under $1 million here. So many investors are always looking for a good area to buy a rental property. And this new article came out by AZ Big Media saying these Phoenix suburbs have seen the biggest increase in renters. So these may be some areas that you would want to target in purchasing a rental property. Glendale is the closest Phoenix suburb to reaching renter majority status, with the renter households now making up 42.4% of all households. Peoria added the most renter households in the metro, 2,374 over 5 years, followed by Goodyear, which gained 1,687 new renter households during the same period. Sun Lakes recorded the fastest renter growth in the region, with a 41.3% increase in renter households in just 5 years. That's pretty interesting. Saddlebrook and Eloy saw significant growth as well. They say on a broader national trend, in the 20 largest U.S. metros, more than 200 suburbs are now renter majority, including 15 that flipped from owner to renter majority over the same 5-year period. Now, obviously, we just talked about affordability. So that is a reason that some folks are deciding to rent versus buy, because it can be more affordable in that sense. If you are, however, an investor and you're looking to purchase a home to be able to rent, this is some good data to have, because you know where that rental demand could be. Now, of course, as an investor, you're facing the same situation with home prices, but there are some creative financing options, seller financing, and, assumable mortgages, which you can actually use even if you're not going to occupy, as long as those are VA loans. So some different ways to get into properties. By the way, if you are interested in an assumable mortgage option, take a look at the description below. I have a link where you can get more information on how that works, as well as a list of homes with assumable mortgages. So if you are gearing up to make a move one way or the other, buying or selling in this real estate market, according to Housing Wire, here's how to think of home prices for the rest of 2025. Now, the good news for buyers is that the overall anticipation is that home prices are going to decrease this year, even further than we've already seen. But as a whole, they're anticipating Arizona to go down by 1.6%. Now, I know that isn't huge and exciting news. It doesn't change the game with affordability all that much. But if you look at the states that are seeing a decrease, some of these in red, Arizona's included in that. There's actually not that many that are seeing a decrease. So it is nice to see that there is a little bit of relief here in Arizona. And we're coming off many years of just continuous price increases. So to see some adjustment in that is a good thing. They're saying that there are slight nuances of home pricing stickiness as financial markets recovered in May and June. The median asking price is 1.3% ahead of 2024, and the price of all homes under contract is 2.5% above 2024. That's looking nationally. Obviously, every market is behaving a little bit different. But they're saying the percentage of homes on the market with price reductions is at a 15-year high for June. 39.5%, which is nearly 40% of all homes on the market, have taken a price reduction from the original list price. We're certainly seeing that here in Phoenix. They say that's significantly more than normal, which would be closer to 30%. No indication that demand is going to push prices higher this year. And then they ask, will the market crash? Now, the reason we're seeing a shift in all of this, particularly in Phoenix, is because we've been seeing an increase in our listings on the market. But we also have been seeing, a bit of a downturn in demand. However, demand has not been suffering, so to speak. It is still there. It is still chugging along, just not at extreme levels that we've seen in the past. Now, I want to take a look at active listings, because last week we started to see a downward trend in active listings on the market. We've remained pretty stable since last week, 26,179, actually a very, very slight uptick from where we were at last week. So let's keep an eye on this. I do expect this to kind of flatten out, maybe even go down through the summer months, but we will see. So for some reason, elevated mortgage rates aren't discouraging home buyers. So this is what I'm talking about. Housing Wire reported that purchase applications were up 20% year over year this week, which is pretty surprising. They say in a total shocker for 2025, which is receiving no airtime whatsoever, purchase application data from last week showed 20% year over year growth and 10% week to week growth. And what purchase application data is basically the intent to buy from buyers who are going to be getting a mortgage. So far in 2025, there have been 11 positive readings of this year over year measure, 8 negative readings, 3 flat prints, and 19 straight weeks of positive year over year data. You can see how they've plotted this on the chart, where we're seeing 2025 pretty clearly elevated above 2024. So while we aren't seeing this intense demand, regardless of the affordability challenges that we just talked about and the number of homes on the market, people are still buying. There is still this demand, and particularly for mortgages, even though rates are where they're at today. Now, the 30-year fixed mortgage rate today stands at about 6.91. We're still under 7, but just barely saw a little bit of a spike over the last week. And a lot has been going on in the geopolitical landscape and economic front. So a lot to watch for. One thing in particular to watch for is the Fed meeting, which is happening today. Although I have recorded this before you're seeing this, so you may know what happens at the Fed meeting. But an interest rate cut is highly unlikely. The Fed is going to meet and decide if they want to change interest rates. And then Jerome Powell will have a press conference. Wall Street considers it a near certainty that the Fed will opt to keep rates at the 4.25% to 4.5% range that they've stood at since December. The CME Group Fed Watch tool indicates markets price in just a 0.1% odds of a cut this week. So don't get too excited about that. Although Trump has been demanding for the Fed to slash rates by a full percentage point. Now, what will be important to watch for is the Fed is going to release its quarterly summary of economic projections, or the dot plot, and that will reveal where Fed staff expects several key economic data points to head in the near future, notably indicating the median expectation for rate cuts from the policymakers who vote on conducting them. When they did this in March, they indicated that the forecast was for 225 basis point cuts this year, but this month's update will reveal just one expected cut in 2025. That's according to B of A forecasts. Of course, a lot of this also depends on what happens with our labor data and inflation data. Those are two things that the Fed is always looking at in order to determine their next move. So if you are a buyer out there, just make sure you're staying in touch with your mortgage lender in case there are any significant changes to rates this week based on the commentary from the Fed or any of these things going on in the geopolitical landscape. All of that can affect markets. And as I mentioned before, if you're looking for some creative finance options, assumable mortgages can be a great option. I have some information in the description below if you want to check that out. Assumable mortgages are a great option for homeowners as well, not just investors. And if you are looking at these rates, trying to decide what your affordability looks like, we have a mortgage calculator that might help you. So check out that link where you can kind of get an idea of what your affordability would look like. Now, let's jump into what's going on here in Phoenix with the Cromford Market Index, as I always share every week. By the way, if any of this is helpful for you, consider subscribing and share this video with someone who would find it helpful. Today, we're sitting at 72.4. Now, anything under 90 is considered a buyer's market. We are most certainly in this buyer's market here in Phoenix. But, keep in mind, buyer's markets have nothing to do with prices. It just means that there are more sellers than there are buyers. So buyers have a little bit more of an advantage compared to sellers in most areas of the valley. Now, demand is below our normal range of 100. So it's at 78.3. 22% below normal, but this isn't like significantly low hurting demand. It's just been kind of hanging out in this same range for a while now. Supply is above normal, about 8.2% above normal, with 100 kind of being that threshold there. So, as I said, we've seen higher supply, lower demand. Therefore, we've got this buyer's market situation. And if you want to take a look at what's going on with all the major cities and their respective CMI, you can see that Fountain Hills and Paradise Valley are leading the pack, as well as Avondale and just barely Chandler, all still technically in sellers markets. Chandler had been in the number 1 spot for months and just recently got bumped out of that and now is in the number 4 spot. So looking at this, we can see that, if you're a seller and you're located in any of these cities, you do have a little bit more of an advantage. Now, these aren't strong sellers markets, but you still have a little bit more, likely because the supply, the competition on the market is a little bit lower, and perhaps demand is also a little bit higher in these areas. On the bottom side of this chart, though, we're looking at Buckeye, Maricopa, Queen Creek, Surprise, Goodyear, Peoria, all of those in a buyer's market, pretty good buyer's market there for most of those. So if you're a seller, you're likely facing a longer time on market, perhaps lowball offers, if any offers, very picky buyers. So it just really depends on what area of the valley that you're in based on what you could be experiencing. And I say all of that from a seller's perspective, but that's good information for buyers to know as well. You may have more leverage in some of these cities here on the bottom of the chart versus some at the top of the chart. I also like to look at the contract ratio every week because this is a little bit more of a real-time view of what's going on. It's comparing the number of listings in every zip code that are available for sale as compared to how many are actually under contract. And you can see a lot of green, some blue, still seeing kind of the same we've been seeing every week here of a balanced, warm market through most of the valley. And then we've got these pockets here in various zip codes that are a little bit more cool, some of those colder areas. And that's mostly where we're seeing some of those, buyers markets and weaker markets all together. Our team has met with a handful of buyers over the last week that are thinking about getting into a home this summer. So if you are one of those people, we do have some availability to still chat with you and help you understand kind of next steps in that process. You can book a free discovery call with our team by checking the description below. But thanks so much for joining me this week, you guys. I will see you next week on my next market update.